Good morning. We're going to talk real quickly about how to pick a good investment. I've seen a lot of people do investments in Bitcoin and crypto and stocks and even as big as real estate, and kind of explain to me why they invested in it and what they expect to get out of it, and what inspired them. And I wanted to take just a few minutes to kind of explain what I looked for and probably what you should look for in a good investment. And so there's a few principles, and not just knowing the words of the principles, but actually what's behind those is the key. And so number one we're going to start with is an investment needs a moat of value. And what that means is that there's a margin of difference between the value of what you're looking at buying and what it's worth to you. Okay, so if you take a house, for instance, and the house is worth $190,000, and the house is selling for $190,000, there's no moat of value for you. And in order to determine a moat of value, you have to have a way to value that asset for you. What is it worth to you? It could be by rent or by return, or all kinds of different methods. You're gonna have to figure that one out on your own. And there has to be a difference. If there's not a difference, don't do the transaction. Don't invest in something that's at market value just to shift your money into that thing. Okay, number two, it needs to be an asset. An asset is not your car unless you rent it out. An asset is not your desk. An asset is not the house you live in. An asset is something that pays you money while you own it. Okay, that's an asset. Now, it can be a trickle of money, but it has to pay you money. Now, when you invest in an asset, that is different than playing with things or just experimenting. You put $50, $100, whatever, little bit pieces in stocks and buy and sell a little bit like that with a tiny piece of portfolio. That's not really an asset. That's not an investment. That's just learning. Okay, there should be money out there to learn with, but a trickle of income means, Bitcoin. I'm in Bitcoin. Why am I in Bitcoin? Most people because they want it to go up in value. Not me. Me because I can put it on an exchange and make 6.2% or 5% on that, makes that an asset. Now, I have a moat of value. What do I think Bitcoin's worth? Maybe $160,000. What is it selling for? $47,000. So that's quite a bit of a moat, even with the risk of Bitcoin. And it makes a trickle. Now, the third criteria for an investment for you is that you have to be able to buy more when it's on sale. Now, I don't care the reason you can't buy more when it's on sale. That's irrelevant. It could be mindset, money, understanding, you're nervous, whatever. You don't have, your job covered. You don't have a basis, but you have to be able to buy more of that asset when it goes on sale. So if you buy a stock at 100 and you do not have the mentality to buy the same stock at 50 when it drops, then that's not a good investment for you. Okay, could be the same for a house, could be the same for a business. Whatever you're buying as an investment has to be something you can buy more of when it drops in half. If you can't, then don't buy it. It's not a good thing for you. When you buy an investment, one of the keys is to know what to keep and what to sell. And so many times the philosophy people have is to sell the ones that went up in value and keep the ones that went down because they have some holding or some mental tying to how much money they put into that. I put $100,000 in this stock, or $50,000 or $500, and now it's only worth $300. I can't sell it. Well, that stock doesn't know what you bought it for. And so over time, you're going to want to make sure that you can hold the best investments that you have and sell the worst investments. Now, can you do that with crypto? Well, that depends on you. Can you do that with real estate? Can you do that with businesses? Can you do that with stocks, right? And so you need to understand yourself enough to understand your behavior and ensure that you hold the things that go up in value. Now, you've seen my video on, one of my best investments. I'm up 1,500% now. If I had sold my best things, they went up, oh, I want to lock in my profits, they say. Lock in the profits. I'm going to sell it. Nope. That's not really how you handle an investment. You don't lock in profits on investments. That's what you do when you're gambling. And gambling is way different than investments. Your odds are way worse. Investments, you have a moat, you have a trickle of income, you can buy more when it goes down, and you're going to hold your best ones. Now, so those things makes it an investment for you. And so when you look and you say, what should I invest in? Well, if you buy Bitcoin at $47,000 and it drops to 25, tell me your mentality about buying more. Are you going to buy more? You might say yes, but let's say it happens, and that was a bad investment for you by your behavior. So it's hard. It's hard to judge an investment because you really have to understand yourself. And understanding yourself and how you're going to behave when the market crashes, I can tell you from personal experience, is very, very, very difficult. One of the techniques I use to be able to judge myself is feelings. And so an example would be in 2008 or 11 time period, I got a feeling that everybody around me was scared. They were talking about selling everything that they have in the stock market. Kramer came out and said, sell all your stocks. And I got a feeling that everyone around me was scared. And what I know is when I get that feeling, I need to go look and see if I need to buy. And buy like majorly. So I look at other people's feelings sometimes. If there's a large amount of fear, then it might be a time for me to shift my assets some in the opposite direction as the fear, right? So in that case, I would have bought index funds and some particular stocks that I wanted to own. And the opposite is true. GM got a partnership with Microsoft, and there's such a hype around automation of self-driving vehicles and electric vehicles that it got the partnership. And the minute it got the partnership, the stock went up by 50%. Everybody's talking about it. Everybody loves it. What do? Well, that's a little bit of a hype. And at 50% higher with no real change in the company, I sold it. Was it a good investment? Sure. But at that point, there was a lot of hysteria I felt around the situation. So one of the ways I know to buy and sell is not based on a feeling that I'm scared, because I think that's usually a feeling I get when I shouldn't sell, or a feeling that I'm excited or don't want to miss out on some opportunity, because that's not really a situation I should buy in either. For me, it has to do with looking at the fear around me, understanding that fear is a lot of times contagious, and it's based on herd mentality. If you're a wildebeest, for instance, and you see everyone around you running, best you run, right? Because there's probably a lion or something else that's chasing you, and best you run as fast as everybody else does and stay right in the middle of that pack. But if you're investing and everybody's running, maybe you should look around to see what they're running from, why they're running, what opportunity that there is because they're running. They're all running someplace else. Maybe the opportunity is where they were. And so those things are hard, and that's difficult to, make a decision where essentially, you're in amongst 100 people and 99 are running and you don't, because by nature, that one that doesn't run gets eaten. But investing is not nature. It doesn't work like nature. It doesn't happen like nature. And so you got to be careful of that herd mentality of, going up when it's up and everything's at the top, everybody feels good and you're buying in, right? That'll keep you safe as a wildebeest, but not a good investor. So hopefully there's some value, and like and subscribe down below. And I'll share some things more in the next video, and I'll talk to you later.